Oh, what a video I have to make here today. I have to explain the actions of good old Wall Street today and what they're up to and what they're planning here, okay? Explain the actions of Wall Street is similar to trying to explain the actions of a 2-year-old. You ever heard of the terrible twos? Anybody that's ever raised kids knows all about the terrible twos and how, a 2-year-old, man, they could be so happy one minute, next thing you know, they're throwing a temper tantrum, going crazy, okay? And that's what it's like for me putting this video here today together, trying to explain the actions of Wall Street and what they have up their sleeve and kind of what's going on. Hope you guys enjoy this as always. Try to make the best of this situation here, but nonetheless, okay? And I'm also going to tell you kind of what I think is going to happen for the market moving forward. I'll cover that in this video as well, okay? So Dow Jones Industrial Average down over 1,000 points. Yes, you heard me right, down over 1,000 points here today. NASDAQ down almost 4%. Ugh. Nasty day in the market. If you didn't lose money today, you are a short seller, because I think that's about the only folks that probably made some money out there today. The VIX went through the roof, okay? Look at this baby, up over 17 flipping flapjacking percent today. Give me a piece of that stock, okay? So yeah, the VIX, basically what that measures is volatility in the market. And look at this little move right there by the VIX, right? So basically, the way to think about this is if you get a massive downward day, like a day like today, okay, 1,000 plus points, you get, trading volumes to go insane, things like that, the VIX is going to skyrocket. Now, when it comes to VIX, it's been relatively low for the last, let's just call it, few months. And that's kind of bothered a few people. They want to still see an elevated VIX, especially with how high inflation is and how many, let's just call it, concerns there are out there in the market still between the Russia-Ukraine situation, right? Between obviously company earnings being weak and obviously inflation and a few other things. Like, people still want to see VIX really high. And the fact that it's been low has definitely rubbed a lot of people, especially on Wall Street, the wrong way. And they kind of want to see this baby start to skyrocket again. And boy, did it make a move here today. That's for dang sure, okay? So I want to show you some of the devastation out there today, and then we'll get into why this happened and my opinion on this and where the market's going from here, essentially, okay? So yeah, it was, very devastating for almost everything. My big tech watch list here today: NVIDIA down over 9%, AMD down over 6%, MU, which is a huge memory chip company, whatever, device you're watching this on right now, you could have MU memory in there. There's a pretty high probability whatever device you're watching this video on right now has MU chips in it, okay? Adobe down over 5%, Shopify down over 5%, Google McDougal making a rare 5% plus downward move. Shopify, NVIDIA's, AMD, stocks like that, 5% moves, not too crazy. Google McDougal over 5%, freakish, okay? That's a freakish move there. You don't see that very often from Google McDougal, okay? Amazon down almost 5% here today. Just ugly times ugly. Apple, the big dog that it is, and Microsoft, the other big dog, the biggest of the bigs, right? They all were basically down just about 4% there, roughly in line with the Qs and with the NASDAQ in general. And the only stock to eke a gain out today was Snowflake, which Snowflake reported some very impressive numbers that a lot of investors were very, very, very impressed with. And, I need to cover that Snowflake situation with Palantir, because a lot of people looked at the Snowflake numbers. Their revenue growth was like somewhere in the 70-80% range. And people were looking at that and they looked at Palantir's growth and like, Palantir only grew this. Do keep in mind, very important, Palantir's U.S. commercial revenue, which is a more comparable business to compare against Snowflake, was up 120%. Okay, so just do keep that in mind. So yeah, a lot of devastation out there across the board. Cathie Wood stocks, ugly times ugly today. TARC was down 12.5%, which is basically a 2x leverage on the ARK ETF. Teladoc was even down 8% plus today. And Teladoc got some good news recently. And basically what happened is Amazon is getting out of a business that was seen as a competitive threat to potentially Teladoc, and Amazon's exiting that business, which is good news for Teladoc, but does it matter in this market? Absolutely not. That stock down 8% plus. Teladoc, I still got to do a little more digging on Teladoc. It could be an interesting play, okay? Coin down huge today. Ethereum, Bitcoin are both down big today. ARK in general down big today. That's kind of what you expect on a big downward day like today, right? Even the safety stocks all got nailed today. This is my safety stocks watch list, which this is where people like to flood money if they're feeling very, very scared. This is where Wall Street likes to plug their money if they're feeling scared, okay? Everything on that watch list was red today. It was Red Dead Redemption, starting with Dollar Tree at almost a 7% downward move here today. That's a huge, huge move. And Dollar Tree, if you're thinking about the Fed tightening more, if you think about the economy getting worse, at the end of the day, Dollar Tree is a company that will prosper in that sort of scenario when people trade down and are shopping more at the dollar store, which many times things are a lot more expensive than a dollar at the dollar store. I remember back when I was a kid, man, you used to go to the dollar store and literally everything at the dollar store was $1. Nowadays, you go to the dollar store and it's it's like $3, $2, $5. It's like, what in the world's going on here, man? The dollar store is not really what it used to be. I guess it's a dollars store now at this point in time, okay? Housing stocks stood no chance today, okay? Rocket down over 10%, which is a huge mortgage-related company. They're in several different businesses, by the way, but that's a huge component of their business, refinances, mortgages in general. Yeah, devastation for them today. 2023 and after, I think Rocket can be a very interesting play. It's in a horrible spot still and going to remain in a horrible spot for the rest of this year, essentially. RH down almost 10%. Luxury homes, and they're not moving. They're not moving right now. A lot of wealthy people are still very concerned about the state of the economy, right? And real estate prices coming down. So RH is another one that's going to be in a very, very tough spot for the remainder of this year and probably into early 2023. So that's why I'm not jumping in that one. I actually like RH as a play long term, but I'm not in a rush to get in that one because luxury housing, it's not flipping right now. Let's just put it that way. We're still probably, a minimum of 6 months away, but you could be more toward a year and a half away from luxury housing kind of starting to come back, okay? So that's why I'm not in a rush to get in that one. And then everything else across the board in the housing stock space just got absolutely obliterated here today. Travel stocks stood no chance here today. CCL down over 5%. All the airlines were down, about 4%, 3% here today. Absolutely, travel just absolutely nailed. They kind of, they move with housing. It's kind of interesting. I got my watch list of stocks down 65% plus, and it was just devastation. I mean, just devastation. The only green on that list was a Planet today. Planet's coming back to life, and this company far-fetched. Outside of that, it was a far-fetched idea if you want anything green out there today, okay? So, all right, for everybody that knows anything about economics, the markets, okay? If I told you that inflation's starting to come down, but we haven't got confirmation that it's going to continue to come down yet, and inflation is still sky high, like ridiculously high, right? And I told you unemployment is super low. And I said, what do you think the Fed's going to do? I think anybody that knows just about anything about economics and Fed policy would be like, probably going to continue to raise rates, right? That's what we expect. They're going to continue to raise rates. And I think anybody with a brain expects that, right? Another rate hike coming in September, and then another one coming later this year. 2 more rate hikes. And the only question is, how aggressive are the rate hikes? Are we talking 75 basis points? Are we talking 50 basis points? Are we talking 25 basis points, right? That's the only thing that's debatable. And that's what we have going on, right? And that's the expectation. But here, Wall Street's throwing a temper tantrum because I don't know what they had planned, okay? But Federal Reserve Chairman Jerome Powell delivered a stern commitment Friday to halting inflation, warning that he expects the central bank to continue raising interest rates in a way that will cause some pain to the U.S. economy. Does anybody on Wall Street have a brain? Of course, if you're going to raise interest rates, it's going to cause some pain. Why do you think the market's gone down so much this year, right? In his much-anticipated annual policy speech at Jackson Hole, Wyoming, Powell affirmed that the Fed will, quote, use our tools forcefully, end quote, to attack inflation that is still running near its highest level in more than 40 years. Okay, nothing in there shocking. We all know that, or should know that. Wall Street, should we not know that? Even with the series of 4 consecutive interest rate increases totaling 2.25 percentage points, Powell said that there's no place to pause or stop, he says, okay? Understandable. Even though the benchmark rates are probably around an area considered neither stimulative nor restrictive to growth. Quote, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. He said in prepared remarks, "These are unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain." This is the same stuff Powell's been saying for months now, basically almost this entire year, but specifically over the past 6 months. There's nothing shocking here. There's nothing shocking here. The Fed's going to remain committed to bringing down inflation. That's what they have to do. And Wall Street sells the market off like nobody's business today on the back of literally no news. What did they think was going to happen here? However, Powell cautioned that the Fed's focus is broader than a month or two of data, and it will continue pushing ahead until inflation moves closer to its 2% longer range goal, which right now we're at like 8%. Okay, so we're a long way from there. We can get there over the next year, but it's going to take some time. He said, quote, "We are moving our policy stance purposely to a level that will be sufficiently restrictive to return to inflation to 2%, he said. Looking into the future, the central bank leader added that, quote, "Restoring price stability will likely require maintaining a restrictive policy stance for some time." Okay. The historical record cautions strongly against prematurely loosening policy. Yes, 100%. You got to see inflation get much, you got to be 100% convinced that inflation is not just coming down, but getting very close to your 2%-ish numbers. Until you are at that point, you can't start cutting rates, certainly, okay? If you start getting closer and closer to that point, maybe you get down to 4, 3, and it's pretty obvious you're heading down to 2, then you could be in a situation where you go ahead and you stop raising rates at that point in time, right? Which is certainly a possibility in 2023, right? Where they look at things and they're like, okay, it's obvious we're on the trajectory down to 2%. Now we can stop raising rates. We just keep the rates the same, right? Then when you get down to those sorts of numbers, and let's say the economy is getting worse and worse, you can start being in a position where you can start cutting rates, potentially, if that's something you need to do. It's also possible that the economy could be on solid enough footing that you don't need to cut rates, and you could just keep rates the same, which isn't the worst thing in the world, and it would actually be a pretty healthy sign for the overall economy. If we had, let's say, my light shut off. If, let's say, we had a interest rate on a Fed funds rate, I'm talking, let's say we had that at a 3.5% number, and we had it there for a while, and the economy didn't fall to shambles, that would be actually really, really healthy, and that would give people a lot of confidence, because there's a thought process out there that will end up eventually being destroyed, because these thought processes are always destroyed. There's a thought process out there that the only way the U.S. economy can be decent is if we have interest rates at 0 or near 0, because we had that for a long, long time, right? And that's a false assumption there. We've done it many, many times in the past where we've had a fairly healthy economy and not had interest rates at 0. But people, because that's what's happened recently, they think that has to be that way, and it doesn't have to be that way, okay? United States inflation rate. Here's the deal, okay? We already saw once this year where inflation fell. And a lot of people thought, okay, inflation peaked and now it's going to get better, right? And so from March to April, inflation rate actually fell. And we thought we'd peaked inflation. Then next thing you know, up and then up again to a 9% plus number that was kind of like shocking, right? So now we have 1 month of data, right? Where the inflation number came down. The Fed can't make any big statements about, oh, inflation's coming down, we're good now, or anything like that based upon 1 month, because what if it jumps back up? The Fed's going to have to see, and I've been telling people this, is going to have to see month after month after month after month of these numbers continuing to come down to feel like they can either stop raising rates or potentially cut rates, but more just stop raising rates, right? They've got to see the August number come down. They got to see the September number come down. They got to see the October number come down, November number come down. If they see continuously, we drop to 8%, 7%, 6%, 5%, 4%, that's when the Fed can start saying, okay, you know what? We can lay off of raising rates a little bit now, and we can just kind of keep things going the way they are. That's the moment they can do that. But that's not happening this year, because we're not getting anywhere close to, 3%, 2% this year. 2023, I think that's a good debate. If we can get down those numbers, I think that's definitely a possibility. But this year, that's not happening. Okay, let's just be quite honest. It's not happening because of how high we went Yeah, we're not magically coming down to 2 or 3% right now. Okay, we're the rest of this year. We just got to see progress in rates continue to come down. That will give the Fed more confidence to not be as aggressive when they go to raise rates. If we can see month after month after month inflation continue to drop and drop and drop, then they're in a situation where they can be like, maybe we'll just do 25 basis points, nothing crazy. Okay, which I think the market would ultimately like. But the fact that the market jumped the gun here and thought, just because 1 month inflation came down, the Fed's going to magically change their stance? Like, come on, man. That's completely unrealistic. There's no way they're going to do that at an 8.5% number. They got to see continually these numbers come down and come down and come down, okay? And so the market today freaks out on the back of this, and I literally woke up and I just was laughing at this. I'm just like, is Wall Street being Wall Street, man? And, I also think there's a lot of games they're playing right now. Here's the deal. Wall Street's got a lot of puts out there. Wall Street's got a lot of shorts out there right now, heavy. So, they're going to do whatever tactics they can do to try to get these markets down. We obviously have seen the market come back, and I'm talking NASDAQ, S&P, and Dow, and Russell come back pretty decent the past couple months. They need to get these babies down because I'm telling you, they got a lot of money. Here's the deal. They got a lot of cash, and they got a lot of short positions. They got a lot of put options out there. And with put options, those maybe expire worthless if you're not at certain prices. So they have to try to get this market down. They have to try to get this baby down. That's why they were selling heavy today and doing everything they could to try to get the algos to sell. Okay. Now, some bad news: real estate. And we spoke about that at the top. Real estate is going to continue to be in a very, very tough place for the remainder of this year. And basically, the 30-year is now back up to 5.5% on average, which is not good. And, if the 10-year keeps spiking, that's not good, man, because then we're going to be talking about potential 30-year on average of like 6% or so. That would be no bueno at all. Very, very bad situation. And we're already in a very, very tough real estate market. If we're talking about, the average 30-year goes to 6% plus, it's just going to get worse. And, the home builders are already stating this. Toll Brothers, I listened to the Toll Brothers conference call. I'm going to probably listen to the Toll Brothers conference call again in the private stock group on Monday. But essentially what Toll Brothers, they said a lot of stuff in that call. It's a very important one. If you haven't listened to that Toll Brothers call, listen to that Toll Brothers call. But, one thing was their signed contracts down 60% year over year. 60%. Which just shows you how few people, and remember, Toll Brothers clients are the wealthiest of any home builder by a mile. The average toll house is close to $1 million in terms of the dollar amount sold, versus their competitors are like the 300 to 400 range, right? So if those people have even pulled back in a big, big way, oh boy, okay, now, what Toll Brothers also said in the call, they said a lot of stuff, okay? One of the things they said was buyer traffic started to come back somewhat in August, and they were feeling optimistic about that. But also remember, the 30-year was moving down as far as getting a 30-year mortgage was moving down, in the back half of July and into early August. Now, all of a sudden, 30-year mortgage is spiking again. What's the situation? And we're getting maybe more uncertainty in the market. Everybody's looking at the Dow down 1,000 points today, and they're like, oh boy, should I go buy a new house right now? I don't know about this, right? And so I think just housing remains in a very, very tough spot for, like I said, the rest of this year and likely into 23, and then we'll see, what kind of transpires in 23. But that's a whole game to play out there. So that's not ideal situation, and obviously there's going to be a lot of jobs lost in the real estate industry over the next 6 to 12 months, in my opinion. A lot of these construction jobs, I've talked about this for months now, all the backlog of homes is all being filled right now and will continue to for the rest of this year. But in 2023, I'm telling you, a lot of these builders are going to be light on new builds, and especially as 23 goes along, and there's going to have to be a lot of jobs lost there, and that's just a tough situation, okay? Now, as far as the AAII investor sentiment, we have gotten more, let's just call it bearish as far as investors in general. This week, only 27% of investors are now bullish on the market for the next 6 months, and 42.4% is now bearish on the market. So we still remain in an overwhelmingly bearish market, and I think that's important for everybody to keep in mind. You saw the indexes obviously performed pretty darn well from basically mid-June all the way through, about mid-August or so. Very, very well. It was a nice comeback. But let's not kid ourselves. We are still in an overwhelmingly bearish market. There's very few people that are bullish on this market for the next 6 months. And that remains the scene we're in right now. Anybody that tries to give you this, oh, people are so bullish right now, and no. What data are they looking at? They're not looking at any realistic data at all, okay? All the growth stocks and speculative stocks are down 70, 80, 90%, okay? The AI investor sentiment, horrible still. Wall Street's positioned with heavy shorts, heavy puts. There's no such thing as, oh, we're so bullish right now. No. Okay, not based upon any data. If you want to lie or just make up stuff in your own head and say, oh, we're still in such a bullish market, you can do that, but it's just not the reality. The reality is this is an overwhelmingly bearish market still, and will likely continue to be for, I would say, probably the rest of this year, okay? Now, let's talk about what I would prefer for the remainder of 2022 when it comes to stock market, but the truth of what's probably going to happen for the remainder of 2022 in the stock market. Okay? So what I would personally prefer is the NASDAQ tanks. I would personally prefer the NASDAQ goes down to 10, 9, 8 range, which would be a substantial drop here, and that would be like, we're talking that would be down 40+% on a year to date. Maybe, 40+%. That's what I would prefer. I've stacked a lot of cash over the last few months, and I'm in a pretty strong cash position, so I would prefer if this baby just kind of tanks and tanks for the rest of this year. However, with that being said, I do not think that's going to be the reality. I think for the rest of 22, the stock market is going to be in no man's land. I think we're just going to be very range bound. Let's call it anywhere from 10.5 to 12.5. I think we're going to kind of move around. I think there's going to be some, weeks when everybody's like, oh my gosh, we're going to new lows, and everybody's freaking out. I think there's going to be some weeks when, it's very good. But in my opinion, I think we're going to probably be in a no man's land market where it's going to be tough to really get it super bearish and sell off insane, and it's going to be hard to get any sort of major move up because we're still in a lot of uncertainty, specifically with the Fed, which everybody's looking at, right? And the Fed's going to likely raise twice more this year, but how much do they raise each time? There's that uncertainty. What are we looking at in 23 for Fed rate hikes if we are, right? Earnings, the fall-time earnings for companies are going to be very important. What are these companies reporting? We're going to start getting a lot of those in late October, early November. And what do these companies have to say? And everybody's going to be looking at that. Are earnings dropping? What's Apple's earnings looking like, right? How are new sales of the new iPhone going to be when that comes out, which the new iPhone, by the way, is going to get shown off in about a week or so. So those are the things everybody's going to be very, very concerned with. And so that just makes it into a market where I feel like we're going to kind of be in no man's land for kind of the rest of this year, in my personal opinion, which is actually a good market to be somebody that's out there buying stocks because you're in a relatively stable market. You can get some nice sell-offs in there where you can get some stocks for very, very cheap prices. There's already a lot of stocks that if you are anybody that has a 3 or 5 year span, as far as your investment horizon, there's a lot of stocks trading incredibly cheap. And if you're in a no man's land market, you can pick up those stocks for month after month after month, right? And throw income at those stocks. Plus, on top of that, you could potentially get some big dips here and there. Like, look at this dip, from 13.2 down to 12.1. That's a major drop there, right? And stocks just got, there's a lot of stocks that have dropped 10, 20% in this amount of time. And so you get to pick up a lot of stocks for much cheaper prices. So that's a pretty good mark to be a part of. So yeah, hope you guys enjoyed this as always with the good old Wall Street 2-year-old. I appreciate you guys joining me as always. Much love. Also, just so you know, we got a massive deal coming up on Labor Day for the Become a Master Stock Market course, which is my #1 stock market course ever. We haven't had a deal on that in a long time, and I mean a long time. So if you want access to that deal when it drops on Labor Day, sign up with the pinned comment down there, and we'll send you over the deal as soon as it drops on Labor Day for that flash sale. Much love as always, and have a great day.